The tool is designed to be used by other central banks and other national authorities to try to estimate how much total collateral their own financial reform initiatives might take in their jurisdiction. So it allows them to put in, just to estimate the financial implications of the regulations that they are in the process of formulating, and trying to determine how many hundreds of billions of dollars, or rupees, or Australian dollars, or pound sterling their banks and their major swap participants are going to have to post with each other or with custodians in order to comply with the provisions that they're working on. In reality, I think the tool is really target marketed more at the public sector authorities than anyone else. The private sector, the market participants that are going to be the enterprises that are actually going to put up this collateral are very interested in it now, in that subject is now moved to the forefront, because in various regulatory jurisdictions there is now enough detail, there's enough meat on the bones now for those people to begin to figure out, how much collateral are they going to have to put up to do business in Europe, in Asia, and in North America. It's a public policy help, I think. When the United States is kind of guilty of being first in the forefront of trying to codify what kind of financial reform it wants to put out there. And the problem with being first is the regulators come up with ideas that make sense, but what the tool allows you to do is it says, okay, if we require risk in the over-the-counter derivatives system to be collateralized at this level, how many hundreds of billions of dollars is that really going to take? And so the collateral is a mechanism that bridges public sector theory with reality. It's like, how much is this going to cost? And what I think what the private sector investment banks will do is they'll calculate, and a lot of them already have. They've already calculated how much collateral they think U.S. financial reform is going to take. That only calculates how much collateral. That doesn't calculate the expense of putting that collateral up with somebody else. And that's more a function of the interest rate, the prevailing interest rate environment. So the tool does not extend into the expense of putting up collateral. It just helps calculate how much total collateral it's going to take to make the financial system safer.